Good afternoon and welcome to today's webinar, Trading Earnings with Limited Risk using OptionsPlay. My name is Scott Green, Marketing Director with eOption, and shortly I'll be introducing our presenter who does all of our OptionsPlay webinars, Tony Zhang. And during today's presentation, Tony will be going over what is trading earnings, why you should trade earnings, the earnings preview, two trading strategies to limit your risk, and options pricing around earnings. And for those who are unfamiliar with OptionsPlay, it's a feature and a tool that is integrated in the eOption trading platform. If you have a live account, you'll be able to access it. So it's for live account holders only. And OptionsPlay helps you with analysis, strategy, and research for trading options. And after Tony gives his presentation, we'll have time for Q&A at the end. So please, at any point, if you have any questions, go ahead and submit your question either via the chat box in your webinar platform, or there's a Q&A box. Either way, we will get to as many questions as we can. Just want to take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. Speaking of the recording, yes, this recording will be available on our website. If you go to eoption.com/optionsplay, there you will see an archive of all of our past webinars. And so once this recording is ready, we will upload it to our website and we'll email everyone who registered for this webinar a link so you can watch it on demand. As I said, the OptionsPlay tool is integrated in our live trading platform. You can see there in the yellow circle across the tabs there, you can find OptionsPlay. You can sign up for for a live account and have access to OptionsPlay and test it out and get to know it. And if you don't have a live trading account, just go to our website, eoption.com, click the green button to open an account and select live trading. And from there, just fill out our application and you'll be ready with a new account in no time. And there you can access OptionsPlay among other features. And once you're ready to start trading, eOption is one of the leaders in low commission rates at $3 per trade plus 15 cents per options contract. Perfect for high volume traders and really traders of all types. So with that being said, I now want to introduce Tony Zhang, the Chief Strategist at OptionsPlay. Tony has over 12 years of experience in the financial services industry. He oversees the development team that created this OptionsPlay tool, as well as creation of some of other innovative tools for options trading and analysis. OptionsPlay is their flagship product, and Tony helped build up the product suite and bring it to market within 18 months. You may have also heard of Tony, or you can also see Tony at speaking events and conferences throughout the year. Next week, he's got the Wealth 365 conference in February. He's doing the Orlando Money Show, and so he stays busy throughout the year with a lot of speaking engagements. So with that being said, I now want to hand it off to Tony Zhang. Go ahead, Tony.
Thank you, Scott, and thank you, everyone, for joining me. Good afternoon. Happy New Year to everyone. I hope everyone had a great holiday season. We're back here at the beginning of this year, kicking off earnings season. Earnings season is just getting started, so that's why we're here to talk about how to go about trading earnings, meaning trading the event around earnings with limited risk. And the key word here is limited risk, because there's lots of different ways that you can trade earnings, but specifically with options, it allows you to take that directional view so that you can bet on if the stock's going to beat or miss on earnings, but also at the same time make sure that you limit your risk, because these are high risk events. Stocks can move quite a bit on earnings if they beat or miss on earnings. You want to make sure that you are on the right side of that trade, but at the end of the day, you can't guarantee that. So if you do find find yourself on the wrong side of that trade, you predicted whether a stock's going to beat or miss incorrectly, you want to make sure that you have limited risk. And one of the few ways to do that is actually utilizing options to do so, because you're moving because the events happen overnight. You can't just place a stop limit order to potentially limit your losses on a trade. So trading options is one of the few ways that really allow you to take that directional view going into earnings, but have limited risk. So those are what we're going to go over here today. But before we start jumping into the actual option strategies themselves and go through some real examples using options play, we're going to start off by talking a little bit about what our expectations are first about the earnings season, what trading earnings even means, and more importantly, why should you trade earnings? Once we cover those topics, what I want to do is take a little bit of time to understand how option pricing is actually affected by earnings, because that's really going to help you understand what different things to look for when you're trading earnings, to understand as to how you can actually profit from trading earnings utilizing options. And then lastly, what we'll do is we'll spend as much time as possible going through quite a few different examples of stocks that have earnings coming up in the next few weeks. We're going to look at those stocks. We're going to look at some bullish and bearish examples. We'll show you how to evaluate an option strategy around earnings so that you can see exactly how much potential reward you can have if you are correct on that trade, and on the same token, how much risk you have if, let's say, you are wrong on that trade, so that you can quickly identify which one of these strategies is suitable for you, and more importantly, showing you a tool that allows you to become self-sufficient in being able to analyze these strategies so that you can start picking different stocks that have earnings coming up and be able to evaluate strategies on those stocks within just a few minutes to be able to quickly leverage that into an options play with limited risk. So let's go ahead and jump into that. This webinar is recorded, so for those of you that are brand new to options, make sure that you take a look at the recording afterwards and follow, because we are going to go through quite a few things relatively quickly. This webinar is for those of you that have some basic understanding of options, and typically utilize for those of you that have experience trading stocks. So let's go ahead and jump in. First, we're going to talk about what our 2018 Q4 earnings preview, because this is the results for the Q4 of 2018. So in order to understand what our expectations for Q4, I think we should first evaluate what we saw in Q3. So number one, Q3 was marked by what we would consider very strong earnings and profit growth. This is really where we saw some of the record corporate profits, both on earnings and profits, and in terms of growth in Q3. So that was a particularly good quarter, Q3. However, during that time, we did see that 15% of S&P companies did mention that they were hurt in some way, shape, or form, or negatively affected by the tariffs and trade wars that we're currently going through right now. That has caused a lot of volatility in the markets in Q4. So that was something that is a big headline for us to pay attention to going into Q4, is how much of that tariff and trade war rhetoric has actually affected corporate profits, because Q4 is really the first full quarter that we've seen of companies being affected by the tariffs. The last thing to also look at in Q3, and this is a theme that we've been talking about since pretty much the Q1 of 2018, is that companies that beat their earnings had small positive moves. However, companies that missed their earnings had huge negative moves. And this is typical of a late bull cycle. Whenever we are 10 years into a bull cycle, we typically see that stocks that beat their earnings are not really being rewarded much by a lot of outperformance, but stocks that miss their earnings tend to see huge moves to the downside. So this means that we typically see a little bit more opportunity for big moves when companies miss than opportunities for big moves when companies beat their earnings. We've even seen quite a few examples of stocks beating their earnings, but the stock price still falling after that earnings announcement. So these are the things to pay attention to. So what do we expect going to Q4? Q4 is really where we expect to see sales growth decelerate. The trade wars and tariffs is certainly a drag of that. However, things like FX rates, things like higher margins, lower margins due to wage inflation, these are all things that are starting to slow down sales growth. And I think one of the prime examples for those of you that follow the markets is looking at Apple stock. Apple stock has been very vocal about the fact that slowdown in China is really affecting their growth, and they're seeing that iPhone sales has really not stayed on par with what their expectations are, and they've lowered their estimates. That's the key theme that we're seeing going into Q4 earnings, is that companies are lowering their estimates. They are saying that they are not seeing the same type of growth in Q4 as they were expecting to see earlier in the year. I think Christmas season was also between Black Friday and Christmas. We've seen that consumer discretionary stocks have not been doing very well because of the fact that there hasn't been a strong demand for goods in Q4 as there was in previous quarters. So that's really what we think is going to be the major theme going into Q4, is a bit of a slowdown in overall growth for both sales and profits in the S&P 500 stocks. However, the one thing that we want to point out is that because we've had such a large pullback in November, December in the equity markets, we do feel that the effects of the trade war and tariffs are likely already priced in. So we don't necessarily believe that you're going to see a huge sell-off, if you will, as stocks lower their estimates, because these things we believe are already currently priced in. And lastly, we are paying attention to wage inflation, which has compressed margins. So we are seeing companies make less profit on the same amount of sales because they have to pay their workers a little bit more because of inflation. The lower oil prices has certainly affected the energy sector substantially, so that is also a drag on the S&P 500's earnings. However, lower oil typically does mean slightly lower costs for certain industries, especially shipping industries, airline industries. These are the types of sectors that typically will do well with lower oil prices. However, a stronger dollar has also produced a bit of a drag. So those are the things and themes to pay attention to going into Q4 earnings. So what are we looking for in terms of sectors? So in terms of sectors that we're seeing the highest upward revisions, so where companies are still reporting increase in sales or expected increase in sales and profits, the sectors that screen best for that are healthcare, industrials, and technology stocks. These are stocks that have taken quite a bit of a hit over the last few months as markets sold off in December. So we do feel that a lot of the trade wars and tariff impact, if you will, has already been priced in. So these stocks still have some upside potential if they do beat their earnings. And on the downside, the stocks that typically are seeing the largest downward revisions, meaning stocks that are reporting expectations that earnings and profits will come in lower than expected, are communications, consumer staples, and financials. These are actually the same sectors we actually looked at in Q3 as we are expecting in Q4. So those are some of the sectors to pay attention to if we're looking for opportunities for either stocks to beat or miss on earnings. So now that we've talked about what our expectations for earnings, what does trading earnings even mean? For those of you that are brand new, let's cover a few different basic questions. Number one, what are earnings? Earnings is very simple. It's when a company reports its revenue, profits, and provides forward guidance as to what they see in the next quarter to come. So this is where they're going to report how earnings, revenues, and profits were for Q4 of 2018 and what they're expecting to see in Q1 of 2019. In reality, the forward guidance at this point is very, very important, if not more important than what we're seeing in previous revenue and quarters for the previous quarter. What companies provide in terms of forward guidance is really what drives share prices right after earnings. So I think a good example of this is Apple, again, because this is a stock that's been in the news substantially for a long period of time as the stock has really taken a beating from well over $200 to about $150, 25%, more than a 25-30% wipe of its entire market cap over the last quarter is all based on their forward guidance of what their expectations are. So that's really where we see the largest impact of forward prices based on a company's forward guidance. Now, why should you pay attention to this, and why should you trade this? And the reason for this is because when companies report their earnings, when they report their revenue, profits, and provide that forward guidance, it creates a tradable binary event with extreme volatility. Now, you can view this in two ways. You can utilize that extreme volatility to potentially profit from it, or you can think of volatility as bad for your portfolio. For the users that are trying to trade earnings, they're really trying to harvest that extreme volatility to try to make a large amount of profit in a very short amount of time. That is the goal of someone trading earnings, is to try to make a large profit in a very short amount of time, because you effectively get an instantaneous repricing of a stock based on the report that comes out. So if it's an extremely positive report, the stock price will usually move higher instantaneously, and if the stock report comes significantly worse than expected, then you have a stock decline in price instantaneously. And that instantaneous increase or decline in that stock price will result in profits or losses depending on whether you bet that that stock will go higher or lower. However, how do you actually go about profiting from this strategy? Or how do you actually profit if the stock moves significantly higher or significantly lower? Number one, we always recommend that you use options. And the reason for this, again, is because options is one of the few strategies that allow you to take that directional view of either believing that the stock will move higher or lower, but doing so with limited risk. So that what you do is you simply buy a call or a put option that allows you to speculate on bullish or bearish views. A call option if you expect the stock to move higher, a put option if you expect it to move lower, and allowing you to do so that no matter what happens, the most you can lose is what you've paid for that call or a put. And I have quite a few examples of some stocks to show you of how to go about doing this. And lastly, when you're going about buying an option, you usually want to choose expirations that are at least 2 weeks after the earnings date. So a lot of users will choose an expiration date right after earnings, and we never recommend that, because typically what happens is once a stock has that initial move, there's usually quite a bit of follow-through, and that follow-through can last anywhere from a few days to a few weeks. And in order to capture that follow-through, you want to make sure that you utilize an option that gives you a bit more time beyond the actual earnings date. So we'll go through that in the examples that we'll show you, but make sure that when you're choosing expiration dates, you choose something that's roughly 2 to 3 weeks beyond the earnings date of the stock. So when it comes to earnings, it's really important to understand how option pricing works around earnings in order to understand how you can profit from the strategy. Now, trading earnings is by no means simple. It's actually quite difficult. And the reason for this is what I call 1 step forward, 2 steps back. What that means is that you really have one thing potentially working in your favor while you have 2 other factors actually working against you when you're trading earnings. So it's really important to understand what's working in your favor, what are the 2 things working against you, so that you can understand how to actually profit from this strategy. Now, the 3 things that are working in your favor or working against you, number 1 is you have a large stock move on a beat or a miss. That's really what's working in your favor, meaning if you're able to call the direction of the stock correctly, that's going to be working in your favor or against you if you are correct or incorrect on that directional bet. But the 2 things that are constantly working against you no matter what is, number 1, what we call volatility crush. This is when the implied volatility of an option will collapse right after earnings, and that's going to decrease the value of your options. And the reason for this is because prior to earnings, volatility is very high because there's a lot of uncertainty around where the earnings is going to be. So people will pay a little bit more for that option because they want to participate in this large move. That will increase the volatility and increase the price of the option. Once that announcement comes out and that uncertainty is gone, that implied volatility will collapse, meaning the uncertainty is now going to go away, and that's going to decrease the price of your option. So volatility is always going to come down right after earnings, and that's going to decrease the value of your option, which is always going to work against you. The second thing that's always working against you is time. When you buy an option, time decay is always working against you. So the shorter the amount of time you are in the option, the less time decay is working against you. So when you're trading options, you don't want to hold on to an option trade for too long, because time decay is going to continuously erode the value of your option. So because these are the three factors to pay attention to, or the three factors that have the largest impact on the option price around earnings, in order to profit from earnings, the large move that you have in the underlying stock must overcome what you lose in the volatility crush and the time decay in order for this strategy to be profitable. So if the large move that you have is greater than the volatility crush and the time decay added together, you're going to make a profit. However, if the move that you expect to does materialize, but it's not large enough and it doesn't overcome the volatility crush and time decay, you can actually call the direction of a stock correctly, but still lose money on this trade. So that's why trading earnings is not an easy strategy, and it's really important to understand these three factors in understanding whether or not you can make money from this trade. So on the next slide, what I want to do is actually dive into these three factors to get a better understanding of each one, so that you can actually calculate how much the stock needs to move, how much the stock will actually, or how much the option will lose to time, to volatility, and how much the option will lose to time. Now, I'm going to introduce the Greeks as the way to calculate this. And I'm bringing this up as a conceptual basis. I'm not asking you to memorize this. I'm not asking you to learn the math behind it. And the reason for it is because the platform OptionsPlay that we'll show you in a few minutes actually does the calculations for you. But it's still important for you to understand the concepts behind the calculations. So we're going to dive into each one to understand each one, but keep in mind that you don't have to memorize each one of these or know how to calculate it. So when we talk about we have the large stock move working in our favor, that's what delta tells us. Delta is the Greek of the option that gives us an understanding as to how much the change in the price of the option is affected by the change of the price in the stock. So if we expect the stock to miss on earnings and move, let's say 10% lower, delta tells us how much money we'd actually expect to make from that option if the stock does move 10% lower. So if you have an example of a call option or a put option with the delta of 0.5, that means the option will increase or decrease by 50 cents or half as much for every $1 that the stock moves. So this delta allows us to get an understanding as to how much money we would make or lose if the stock moves higher or lower. Vega, which is the change in price of the option with respect to volatility, gives us an idea as far as how much the option price will lose in value from that volatility crush that happens right after earnings. So if you have a call or a put option that has a Vega of 0.25, that means the call or put option will lose 25 cents for every 1% change in implied volatility. And lastly, theta. Theta tells us the change in the price of the option with respect to time. So if you have a call or a put option that has a theta of 0.1, that tells you that the option is losing 10 cents for each day that goes by. So that's how we're able to quantify exactly how much money we actually make from the stock moving. That's delta. And that needs to be overcome by the money that we're losing to Vega, or volatility, and to theta combined. So we can add the amount of money that we lose to Vega and theta together, and then we subtract it from the amount of money we gain from delta, and that gives us an idea as far as whether the strategy will be profitable or not profitable at after the earnings date. So again, how do we actually do that in practicality? That's what we're here to show you. We're going to give you some examples. We're going to show you how OptionsPlay does the calculations for you so that you just look at the end result, which is really what you're looking for, is how much profit or how much loss can I have from trading earnings. So before we jump right into showing you some examples, I want to cover two option trading strategies that you could deploy when you're trading earnings. First one is buying a call or a put. This is the simplest of strategies to trade. For those of you that are newer to options, this is probably where you want to focus your attention on first to understand. And for those of you that have a bit more experience trading options, looking at a call call vertical or put vertical is an alternative that you can use to trading earnings. Now, what I'll do is I'll compare these two strategies to give you an understanding of the differences, because even if you are an experienced trader, there are different use cases for each one. So it's really important to understand what are the pros and cons of each one in order to help you decide which strategy is best suited for you. So for long calls or puts, this strategy is characterized by a strategy with unlimited profit potential. This is really a lot of times what you're looking for when you're trading earnings, is because you expect a large, big move. Sometimes that move can be quite large. So you want to be able to have that unlimited profit potential, and buying a call or a put really gives you that. However, this strategy is only useful if you expect a large move. And the reason for that is because this strategy does typically have a larger amount of capital at risk compared to a call vertical or put vertical. So because you're risking a larger amount, you need to have a bigger move of the underlying stock on that beat or miss on earnings in order for the strategy to be profitable. Conversely, to buying a call vertical or put vertical, this strategy has limited profit potential. So you will have, to some degree, a cap as to how much money you can make on an earnings move when you buy a call or a put vertical. This is a strategy where you expect more of a modest or maybe a slower move on earnings. So for those of you that are trading more large cap, blue chip stocks, you may expect more of a modest or slower move. Usually blue chip stocks, you usually don't see huge gaps in earnings. Not to say it's not possible, but it's generally speaking that on the larger the name, the smaller or the muted the move that you have on earnings. And this strategy does have a smaller amount of capital at risk. So you don't need to have such a large move in the underlying stock in order for the strategy to be profitable. For those of you that are trading more high-flying stocks, so biotech stocks with a bit more volatility, stocks that are smaller cap, these are names that have a higher probability of a big move. That's where typically you might be trading more of a long call or a put. And again, just to reiterate, you want to make sure that you pick expirations that are at least 1 to 2 weeks after the earnings date to give yourself a little bit more time after earnings in order for the stock to have some follow through and be able to profit from that. So with that, let's jump over to the OptionsPlay module. This is a tool that you have access to within your Regal Securities platform. As you can see, the OptionsPlay tool is available to you on the OptionsPlay tab within your trading platform. And if you don't, you can always add it under the OptionsPlay tool under Add Widget. And what it brings you to is a platform that looks like this. For those of you that are brand new, welcome. For those of you that have traded this or utilized this tool before, what I'm going to do is I'm going to walk you through some examples of stocks that are reporting earnings in the next few weeks, and showing you how to utilize this tool to analyze those trades and be able to use our P&L simulator to show you exactly how much profit or loss you can expect from each strategy so that you can decide whether this is suitable for you, and more importantly, show you how you can become self-sufficient in being able to analyze these strategies on your own. So for those of you that are brand new to OptionsPlay, this tool is divided into 3 sections. We have trade ideas and watch list here on the left-hand side of the screen. In the middle, we have our security analysis panel. And on the right-hand side, we have trading and income. These 3 panels are what we consider the what, the why, and the how of options trading. Trade ideas and watch list provide you with fresh ideas every single day. You have bullish and bearish ideas for fresh ideas. You can create your own watch list or use any of the sector watch lists that we've created for you to see how each sector is performing. In the middle panel, you can type in any stock and be able to see our instant stock analysis of each stock. What we have is a 1-month and 6-month trend analysis to give you an idea as far as the short and long-term trend of a stock. We even display to you that trend indicator underneath the chart so that you can see how that trend has changed over time and see how long the stock has been in the current trend for. So as you can see, Intel has been in this bullish trend for just a few days since January 4th, when it turned both 1-month and 6-month trend turned neutral on January 10th. So just a few days old. So this is the start of a relatively new trend. And then below that, you have important information such as earnings, dividends, and price action data. So as you can see, Intel here reports earnings here in 9 days. So this is one of the stocks that we'll look at. for our strategy. And then once you have an underlying view on the stock, what we have is trading and income. Today we're going to focus on trading because we're looking for trading strategies. We're trying to speculate on the direction of a stock. So by looking at Intel, what we instantly offer you is 3 strategies. If you're bullish on the stock, we'll show you 3 bullish strategies: buying the stock, buying a call option. This is the simple call strategy that you would trade on earnings, and the call vertical, the more complex strategy that you can trade on earnings. And we'll always default to these 3 strategies and provide you with not only the strategy itself, but also provide you with starting points on expiration date and strike price. This means that you don't have to necessarily pull up an option chain, go through the entire chain just to look for an expiration date or strike price to start with. We will provide you with some guidance as to where to start. And then same thing for bearish. Selecting 3 strategies if you're bearish on Intel: shorting the stock, buying a put option, a simple option strategy, or buying a put vertical, a more complex option strategies on bearish Intel strategies. And what we have below here is a P&L simulator. This is really where we calculate the Greeks for you. All you have to do is input where you think the stock will go, when you think it'll hit that price buy, and the volatility that you expect it to have on at that time, in order for us to calculate delta, theta, and vega for you, so that you get just the end result, which is what you're looking for, is how much profit or loss you'd actually expect from each one of these 3 strategies. So let's go through an example here. Let's look at Intel. Intel is a technology stock. This is a stock that is quite interesting because during the December sell-off, as all the other tech stocks have really taken a huge jump, Intel did not actually move down by much. It moved from 49 down to about 44, and actually today recovered back to that 49 level. That can't be said for most other tech stocks. So this is a stock that I think on the relative basis is relatively strong. It's certainly a sector that scans relatively well for Intel. Technology. So I think that if this stock does beat earnings on January 24th, there's a good chance that it'll break above that 49 resistance level and move up to at least maybe 51 or 52 level. This is where it was trading at. 52 was trading at back in July, and it's really been range bound since then between this 45 and 49 level. So, this earnings may be the catalyst it needs to move above that earnings, or move above that channel back to that 51, 52 area. So what I'm going to do is I'm going to use, I'm going to click on I'm bullish for Intel. I'm going to look at my 3 strategies. This is selecting a March expiration for me, which gives me plenty of time after the January 24th earnings date. I can even change the expiration date to maybe the February monthly expirations if I want to, just to compare this. So maybe I'll change this to the February monthly expirations to compare. And then what I can use is I can use the P&L simulator to say that if the stock, which is trading around 48.60 right now, moves up to, let's say, 52 a few days after earnings. So earnings is on January 24th. So let's say a week after earnings on January 31st or February 1st, the stock moves up to $52. And I know that volatility does come down a bit after earnings. So it's really important to look at that. And let's say this comes down from about 30 down to 25%, comes down a little bit on earnings. How much money do I actually expect to make from each one of these 3 strategies? So first of all, if I bought the stock, I make a 7% return. That's a nice return in just a couple of weeks. However, compare that to buying a call option. I'm going to make a 90% return because to buy 100 shares of the stock cost me $4,800. Buying a call option, only $214. Buying a call vertical, only $187, but I'm only going to make an 81% return. So in this particular case, I'm probably looking at buying that February $48 call option that gives me that upside exposure so that if I'm correct, I make a 90% return on my money versus just 7% and 81% on the call vertical. However, most importantly, one of the things to make sure that you pay attention to where you're trading options is the risk, actually. So there is the possibility that Intel misses on earnings. The other chip stocks have not been doing very well. Qualcomm, Texas Instruments, these are stocks that are not doing very well. So perhaps Intel is a little bit mispriced. Maybe it will miss on earnings. So let's say the stock moves back down to 45, 44, which is the lower end of that range. What happens if that happens? So if this stock moves down to $44, as you can see that if you had bought the stock going into earnings, which is another way to trade this, you have unlimited risk. So if I bought 100 shares of that stock, I lose $457 if this stock doesn't go the direction that I expected to. That's a lot of risk to make. That's about 10% of the 4,800 that I have to put up in order to trade that. Not something I necessarily want to risk. Versus if I only bought the call option, I only lose $209. If I bought the call vertical, I lose $173. So this allows me to start looking at not only what is my potential reward if I'm right on this trade, so if the stock does go up to 52, how much money do I make? About $209. And if I'm wrong, what happens if the stock goes down? I also lose about $209. So in this particular case, I have a fairly even, gain to loss ratio, which is very similar to what I would make on the stock. However, I don't have unlimited losses to the downside. So even if stock goes down to $30, so if the stock goes down to $30, I lose 17% on the stock, but I still only lose the $214 on the call option. And that's really the benefit of trading options going into earnings. Let's go through some more examples just to kind of help drive this this concept home. Starbucks. This is a stock that I was looking at earlier this week. An interesting stock. This stock really rallied going into November. Certainly took a dip with all the other stocks, and has really been trading range bound since. And I think there's a few different ways to look at this. This is a stock that's really hit around that 64 resistance level, but has continued to make higher highs. So there is the possibility that this thing breaks above that 64 resistance level and goes back up to that 67, 68 level. That's one way to look at it. The other way to look at it is the 1 month and 6 month trend has really kind of deteriorated a bit. As you can see, when it moved higher, the trends were clearly bullish and has just slowly deteriorated since December as it turned from all green to red and yellow, and now it's bearish and neutral. So, you may think that this stock has more of an impetus to move down to maybe $60 or even $58 to that prior gap before the last earnings. So we can look at both examples. I don't particularly have a directional view on Starbucks. I don't know if any of you guys do, but let's take a look at a bearish view on Starbucks. Let's say what happens if Starbucks misses on earnings. So here I have January 24th, again, January 24th earnings in 9 days. The stock's trading at $64. Let's click on I'm bearish and look at 3 bearish scenarios. So to short the stock, it's going to cost me a substantial amount of capital to get in that. Buying a put option only cost me $294. Buying a put spread, $233. So again, let's say the stock we think can go down to maybe 58, 59 a few days after earnings, let's say February 1st. And again, we know volatility does come down a bit after earnings. So let's say it comes down a bit after earnings. So if the stock goes down to $59, as you can see, if I shorted the stock, I make 7.5% return. If I bought a put option, 104% return. If I bought the put spread, 105% return. So slightly higher return here on the put spread than the call, than the put. So in this particular case, considering this cost me less money to get in, I probably consider buying this put vertical versus just outright buying a put. And conversely, what happens if I'm wrong? What happens if Starbucks does beat on earnings, goes back up to 67, 68? How much money do I lose? Really important to look at both scenarios so that you can see what your expected gain is, but also what your expected loss is if you're wrong. So here, if you had shorted the stock, a $419 loss, bought the put option, $257 loss, put vertical, only $197 loss. So as you can see, this put vertical gives me a higher options play score. And a lot of people ask me, what does that mean? And the answer is really what we're looking at is how much money can you potentially make? How much money can you potentially lose? Weight it by its probabilities to give you a true sense of what the risk to reward of each strategy is. So because this strategy here on the right gives you the smallest amount of loss if you're wrong, but at the same time gives you the highest profits if you're right, That's why we have a higher options play score, because we're minimizing risk at the same time maximizing your return. And that's what the options play score is telling you, is how well balanced that risk to reward truly is. So you can utilize this tool to allow you to quickly look at any stock, gain a directional view using our trend indicator, and then quickly using I'm bullish and I'm bearish to set up 3 strategies, use the P&L simulator to create different scenarios to see what your profit is if you're right, what your losses are if you're wrong, and be able to instantaneously see if this is a strategy that's suitable for you. If it is, all you have to do is hit the trade button. And what we do is we give you the details of each trade. We even have a strategy checklist just to make sure you understand the trend and that you're trading with the trend. The options play score is good, checking for earnings, and making sure you understand the liquidity of an option before you place that trade. And if this is a trade that you're ready to make, one of the coolest things we've done with the Regal Securities platform is you can click on the trading strategy. And I'm not sure why here that we're not able to look at March 1st, but let's say we look at a February 31st, buying the 65, selling the 60 put vertical. You can trade that, and what you can do is you can hit the preview order button, and what that does is actually pre-fills the ticket for you. This is designed so that we minimize the number of mistakes that you make when you're entering the order. There's a lot of different parameters that you have to enter when you're entering order, so we want to pre-fill the ticket for you instantaneously so that you're able to simply hit the trade button, hit the preview order button, and be able to have everything pre-filled for you so you can just verify and send that order off for execution. So we have a few more minutes to go through a couple of more examples here. I want to look at Altria Group. This is what we consider a relatively blue chip stock, high dividend paying stock. However, it's taken a huge beating over the last couple of months and has really not recovered. This is fairly bearish for the stock, so I'd be looking at more bearish opportunities on this stock. This stock reports earnings on January 31st. So looking at the I'm bearish trade, let's say the stock really moves down or moves down to maybe $45. And I think this is going to be an example of a stock where you may not get the same effect that you might want it to. So January 31st is earnings. So let's say a week after earnings. January 31st is earnings. So let's say a week after earnings, the volatility comes down a little. As you can see here, the returns don't look as attractive. A 65% return if you had bought the put, a 50% return if you had bought the put vertical. This really comes down to the fact that these options are actually quite expensive. That's why you have a low options play score. So 66, 70, these are red options play scores telling you that these options are fairly expensive. So as you can see, because they're so expensive, you're just not going to make as much of a return. And when you're wrong, you're going to lose a relatively larger amount of capital. So this is an example of a stock that perhaps it may not be as attractive to play earnings on. Let's look at Apple. I think Apple is another one that a lot of people are looking at. I think certainly Apple has done a very good job of providing guidance that the slowdown in China is really affecting them. Perhaps this is a little oversold, and I think some people might feel the same way. So maybe I'm going to say that Apple reports earnings in 2 weeks. Maybe things are going to look a little better than they kind of painted the picture of. So I'm going to look at some bullish strategies on Apple. Apple's trading at 153 after taking a large tumble from 230 peak down to 153. That's a very large move. That's an $80 move. Almost a 40% move over just a few months. So let's take a look at what if this trade was a little overdone, and let's say the stock is going to beat on earnings and maybe pop back up to 175 or so. So let's say we think the stock will move up to 175 a few weeks after earnings on February 7th, and the stock volatility drops a little. As you can see here, it looks very, very attractive. If the stock moves back up to 175, a 244% return if the stock does move higher. 162 on the vertical, only a 14% gain on the stock. 14% gain on the stock in 2 weeks is a pretty good result in my opinion, but as you can see, a call gives you a 244% return, and instead of putting up $15,000 to place that bet, you only have to put up $655, which is your absolute loss, because even if Apple does continue to move lower, let's say the stock does go back down to its previous low around 142. As you can see here, if you bought the stock, you lose $1,100. If you bought the call option, only $616. If you bought the vertical, only $491. So really depending on where you think Apple will go, if you think the stock might modestly beat, even a modest beat of 165, I think, you'll still see a higher return here on the call versus the call vertical. But if it does get a big beat, which I think there's a possibility of, considering of how far the stock has really moved over the last few months, you do get a really outsized return if the stock does beat. So this is really how you can utilize this tool. Type in any stock, utilize our bullish and bearish readings to give you a sense for direction. Use the bullish and bearish buttons here at the bottom to set up 3 bullish strategies or 3 bearish strategies. And most importantly, utilizing the P&L simulator so that you can really see how much money you can expect to make or lose for any strategy with any given outlook, so that you can understand how each strategy will perform if the stock goes in the direction you expect it to, or if it doesn't, so that you're prepared for this before you go into that trade. So with that, that wraps up what I wanted to show you guys here today. What I'll do is I'll open this up for Q&A so that you guys can ask some questions regarding anything that I went over here today. Any questions regarding the P&L simulator or how to trade options, please feel free to type in your questions into either the chat window or the Q&A window, and I will answer as many questions as I have time for here today. So it looks like we already have a few questions here. Corey's asking, isn't it better to use debit spreads to help offset the higher implied volatility? These are debit spreads, Corey, so this call vertical here is a debit spread that we are using here. Greg is saying, where do the volatility numbers and range come from on the P&L simulator? So the volatility number always starts off at the current volatility. So the current at the money volatility of Apple for the March 1st expiration, which is what we're trading here, is about 28%. And the range is simply just a 3 standard deviation move of that range. So you have a very large range of where that volatility can move to within around the current vol. I hope that answers your question, Greg. Clifford's asking, will there be a recording of this? Yes, this webinar is recorded. Michael's saying, can you show what the straddle can do or strangle? Sure. So let's say instead of looking at buying or selling the stock here, let's say we decided to sell the strangle on Apple. So this is typical. This is a very, very what I would consider advanced trading strategy, because this effectively requires you to have a high amount of margin, and it puts you at unlimited risk. So let's say you sold the March 1st 152.5 straddle. As you can see, as long as the stock stays between 140 and 162 and 164, this strategy will be profitable. So this is more of a neutral strategy. This is saying that I think that Apple's priced relatively well. I think it will stay exactly where it is. And if it does, how much money do I actually make from each one of these strategies? So as you can see that if you sold this 152.5 straddle and the stock stays around 153 a week after earnings and volatility comes down, you make a $545 profit. However, in order to enter this trade, you need to put up a substantial amount of margin to do so, and this is presuming that you even have the ability to short naked calls and puts in your account. Again, this is a much more advanced strategy to trade, but you can utilize this tool. You can click on Modify, use our strategy constructor. If you're neutral, you can short a straddle or a strangle. If you think that the stock's going to make a large move, you can go long a straddle or a strangle. And you can use any of these tools to help you model how these strategies will perform if the stock stays where it is. So if the stock does stay where it is, as you can see, you make a 46% loss. And as you can see, if the stock does make a big move, that's when the strategy will make you a profit. So you can utilize this tool for trading all different types of strategies. Walt is saying, will you sometime cover selling vol crush? So you can certainly sell vol crush, and I think the best example of this is what I just said right now, is short the straddle. That's really where you're selling vol crush. However, again, this comes with a high amount of risk, comes with unlimited risk to the downside on both sides, requires high amount of margin to enter this, and it requires you to have level 5 clearance on your trading account. Not everyone does, but that's really how you would sell vol crush. And that's why I don't cover it, because it's not a strategy that your typical trader would be able to trade. But if you do want to do this, shorting a straddle is one of the ways to do so. Dimas is saying, would it be better with a credit spread? So here's the reason that we typically don't use credit spreads for earnings, because with earnings, I would say that you generally have, close to a 50-50 shot of being able to call whether a stock is going to move in your favor or against you on an option. Now, if instead I sold a credit spread, the reason that you don't want to, that we typically don't look at credit spreads, sorry, let me look at a short put vertical here. Let me set up a short put vertical here instead of the debit spread. So the reason that we typically don't look at credit spreads versus debit spreads is because of the inverted risk to reward. So when you have a relatively 50-50 shot of calling the directional view of a stock on earnings correctly, you don't want to have a strategy that gives you a high amount of risk versus the amount of reward that you can collect. Because even if you're right 60% of the time, the 40% of the time that you are incorrect, you're going to lose substantially more than what you make up, versus the debit spread gives you a substantially higher reward when you're correct and a substantially lower risk when you're wrong. So yes, selling credit spreads is better from a volatility perspective, but the gains that you have in the volatility perspective does not offset what you lose from delta. And when you're selling a credit spread, the risk to reward is just skewed against you right off the bat. And it's really difficult to overcome that, even if you have that volatility edge, because that volatility edge is actually not that big. And it's certainly not big enough to overcome this huge imbalance in risk to reward. So that's why we typically don't look at selling credit spreads going into earnings. Any other questions? How many days do you make the trade before the earnings day? Great question. So theta is the thing that we want to consider when deciding when to get into the trade. So we usually like to enter the trade about up to 2 weeks prior to earnings. You don't want to enter right before earnings because volatility tends to be very high and options tend to be very, very expensive. So that's why we generally want to use about 1 to 2 weeks prior to earnings is a good time to enter an options trade. Any other questions?
Okay, I think that does it, Tony.
Thank you, Scott. Thank you, everyone, for taking the time out this afternoon. Again, trading earnings is something that is complex. There's a lot of moving parts to looking at it. So making sure that you understand delta, theta, and vega are really important. Just keep in mind that OptionsPlay does the calculation for you, so don't feel intimidated or scared by the Greeks. This is really how we're designed to provide you with the inputs of delta, vega, theta, but not requiring you to actually doing the math. So take the time, model out your different scenarios based on the different outlooks that you have on the stock, and be able to see for yourself exactly how much profit or loss. That's really going to be able to help you decide whether this is an earnings play that you want to trade or not.
Well, thank you very much, Tony. Always great stuff and great timing with there being earnings season. And if anybody has any more questions, please reach out to the eOption customer support team. We have the phone number there on your screen, as well as the email address. We can be available both ways. There is a recording of this webinar, so you can watch it on demand. And so we'll have that video updated, ready to go this week, I believe. And so we'll send an email with the link to the recording to all those who've registered. So be on the lookout for an email so you can watch this again. And if you have any questions, please reach out to us. Again, thanks to Tony Zhang over at OptionsPlay. It's a great tool. If you don't have a live account, go ahead and sign up for one today, and you can get started on OptionsPlay. So thanks again for everyone for attending and for all the questions. We love the participation. Please reach out to us with any questions. And everyone, have a great rest of the day. Thanks.